Hello, good evening, and this is the Oak Bloke. So I'm going to be talking about LendInvest. None of this is advice. It's me talking about a share that I own, which is LendInvest PLC. And this is going to be covering an article that is going to be released on my Substack in the next day or so. So it's an article called Living It Up. Uh, and for those of you who read my prior article, you'll recognize Uncle Derek, the imaginary Uncle Derek, who's wearing Aunt Mabel's hat, and who knows. But that was the original article where I compared BETR, which is an American fintech similar to LendInvest, and that in turn was down to a reader saying, could you look at better in BETR, better better home? There we go. And I did, and I said, I don't think. Well, I gave my opinion. I didn't like it, but I sort of took the initiative to think, well, let's compare it to something in the UK. Let's see how it compares. So hence the this picture last year. So this year it's just Uncle Derek. Uncle Sam's not getting not well. Uncle Sam does get a quick mention because if you'd ignored me and gone ahead and bought Better Home and Finance Holding back here at $19, so you would have lost about a third of your money. And meanwhile, if you'd bought um, LendInvest, well, you would have lost a bit of your money up until February. But in the last couple of months, you'll see, well, actually, if you'd bought here, obviously it's not up to me to tell you when to buy, it's up to you to tell yourself when to buy. You make your own investment decisions, but if you were clever enough to buy here, you would have been you would have nearly doubled your money today. But if you'd bought it on the day that you read my article, which was back here on the 12th of August, you'd be up by a third. Okay, so but anyway, that's just a bit of information. So I ask, is this going to be a Linford Christie in 2025? So let's see if we can work that one out. So other people have looked at this and said cautiously optimistic, achieving a run rate profitability during rest of the year. So let's add some color to that. So profitable in September obviously is a positive sign. So what they tell us, well, actually, let me just quickly cover off good old Better Home. Uh, I had a look to see what they were up to, see if they'd actually made any progress. So they've plastered their whole website and investor presentation with Betsy, which is trademarked. So if you're called Betsy, but bad luck, your name has been trademarked. Presumably, you have to ask permission to use your name going forwards because it's been trademarked. So anyway, everything is about AI, and I can't help but feel, it's just my opinion, but I can't help but feel that it's sort of jumped on the bandwagon, plastering everything with AI. There's AI agents. There's and I asked myself, well, what's Betsy? Well, Betsy, it turns out, is an auto dialer. Now, auto dialers have been around longer than AI, and yeah, I sort of well, half jokingly say, I hope that there's an AI powered voicemail used by all the customers getting rung or all the prospects getting rung to screen out those annoying automated auto dialer phone calls. But that's just my opinion. Uh, I dislike such phone calls, and I think majority of people do. It's not something LendInvest do, to my knowledge. They it's inward inquiry. They work with brokers. Yeah, it's a different market where it's about the customer coming either to direct or coming via a broker, and it's all about being customer led rather than pushing a service. So anyway, that's so. uh, I kind of looked at this and sort of said, well, how much money were they making? So in their last results, Q1 25, their revenue was 33 million, up from 22 million, which sounds good. That's obviously an improvement. But their net loss was $51 million, which was a reduced loss from 59 million. I was like, okay, so you're losing a lot of money. And weirdly, the EBITDA loss was 40 million, or adjusted EBITDA loss was 40 million, but the net loss was 50. Yeah, anyway, it sort of it struck me that they hadn't made much progress in about 12 months, unfortunately. So hopefully there's nobody listening to this video that ever got involved with them and has lost a load of money. The other thing that just final thing to say was, back when I looked at them last year, last August, they had net assets of 44 million. In the last results, they've got a negative net assets and net liabilities of 100 minus. Uh, they've got net liabilities of 102 million, so it's gone horribly wrong. But get this. Um, if you wanted to go and buy the whole of BETR, it would cost you a cool 161 million pounds for a company that's losing uh, $50 million per quarter. LendInvest, on the other hand, you can buy for about a third of that money. Now, is it the case that maybe one has better technology than the other? You need to decide that, but we I think we can sort of look at today why LendInvest is actually a very strong contender in this market. And actually, if you go back and read this article, one of the criticisms I made of BETR was that they said, "Oh, we do insurance, we do conveyancing, we do this, we do that, we do the other." They seem to be spread very, 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 very thin. They had a UK operation called Birmingham Bank, which I'd never heard of. I looked at the Birmingham Bank website, and all of the AI driven stuff that they said they had, there was no sign of any of that. To be fair, I didn't try applying for a mortgage in America, but I did sort of think, well, can I try one in the UK? And it basically said, ring this number. So I was like, well, okay, so you haven't got like an online application form with sort of the ability to apply for a mortgage as LendInvest do. So again, there's no proof of the pudding that I could find. So is the technology of LendInvest more tangible and potentially real? Potentially, I believe the answer could be yes to that, but that's obviously a value judgment. So anyway, let's get back into this. So let's move on from good old BETR. So this has gone from back when I looked at it. Back when I looked at it, it was stood at 39.5 million market cap and net assets of 59.3. You'll see when I started writing this article, which was I think yesterday or the day before, it was on a market cap of 52. In the space of a day, it's gone up another few million. You can see there's little up there, although it does say 38p 40p, so I'm not sure. But anyway, it's around 50 million market cap. Net assets have sort of more or less stayed the same. There's a slight drop there. The obviously a third of the price. So LendInvest, for those who don't know, it's a specialist lender. Does buy-to-let mortgages, does bridge loans, so interim loans for property development. So you can see here, fast-growing, innovative funding model, track record of excellence, 7.5 billion in loans funded. driving change in property finance, and a trusted partner. Now, obviously, that's a really good set of badges. I mean, you can't argue with that. So that's so the model a few years ago was that they were doing a lot of direct lending. So they'd raised a load of money via bonds. They've got so actually, if you want to go and buy LendInvest bonds, those are for sale, which are, let me think what they are called. They are called Lend Invest. There they are. Look, so you've got live for, live three, live for today, live for tomorrow. Obviously, 6.5%, 11.5% is the face value on them. So this one, for example, that you can buy for £107 and 10 pence will give you a 10.9% yield. Now, one option would be to buy the bond, because obviously pecking order wise, you're in front of people's, shareholders, ordinary shareholders. You would get your money before, in the event that LendInvest went, you'd get your money before equity shareholders would. Doesn't mean that you're guaranteed to get your money, but it means you're ahead in the queue. You're behind the tax man, afraid to say. Everyone's behind the tax man, but you'd be in front of equity shareholders. So that's actually very interesting. I hadn't looked at that before just now. So that's intriguing that that's also available. So if you wanted a lower risk option that nevertheless pays a very, very chunky dividend. Now, the other thing to say though is that this will have a expiry date, and actually, haha, that's why it's 10.9. So that means that that's due to expire October 2026, which would mean you get back £100. So you would lose £7.10, but you would gain between now and, well, 15 months time, you would gain 10.9. So you'd get about 14% interest or bond payment, bond, what are they even called? Well, like dividends essentially. You'd get that of dividends, but you would get a -7%. So you'd get sort of 7% net, something like that, for tying up your money for 16 months. So it's not terrible, but that's actually not that amazing after all, assuming that that is the date that these do cease to exist, that they'll get refinanced or that they'll get. But sometimes with these bonds, is that they do get extended or they get refinanced. So there's potentially other things that could happen to them. If we go and look at Live 3, which was the other one, that one's at a lower rate, 6.5. So that one's got a yield of 6.6, and you can see here, the kicker here, and obviously that's got a slightly longer run time, but you get a 75p upside because you would get £100 back. So you get 75p plus 6.5% on you get £6.50 on £99, which is the 6.34%. Anyway, didn't really intend to kind of talk about bonds, but there we are. We've sort of covered those briefly. Key financials. I mean, the thing that really struck my eye was that the platform assets under management are growing. Now, what that means is that these guys get money for lending, so they borrow money via bonds and other things to lend to people. So they pay out a dividend or a payment to bondholders, and then they charge a mortgage rate to the borrower. So that's kind of what we see here. The net interest income, and mortgages is the buy to let, and the capital is the short-term lending. If you go back in time to maybe here, it's actually called, oh no, actually, that's the, in here maybe, that if we look at the segmentation, that it's if you go far enough back, it's called um, short term and so on. So there is a little bit of yes. Just find segment. Segment analysis. Yeah, so they've got the um, mortgages and capital here, and maybe we've got to get back to 2023. I'm just trying to find what I did with 2023's accounts. They were here a minute ago, but I seem to have close them down. Anyway, doesn't matter. The point is that the assets under management are growing, funds under management are growing. Now, the difference between these two numbers is this is what you've actually sort of got lent to somebody. Okay, so this is how many, this is your loan book, whereas this is how much money you've got in your kitty that you can loan out. So they're not the same thing, but basically you use this to lend, and that it becomes that. Okay, is how this works. So as you can see, they've got what, about 1.7 billion left to lend to people as at 30th of September. So and that's kind of what I talk about here, that the other part to this is that these loans can either be on balance sheet, which, as I say, they borrow money from bondholders and lend it out to mortgage holders. Okay, so that's one model, and that's kind of where they got slightly unstuck, because the problem is if you lend money and then the person you've lent it to goes bust, you've then got an impairment and you've lost your money directly. Whereas if you do what's called funds under management, so this is off balance sheet, or it's not on LendInvest balance sheet, the idea is that you get a fee, a lower fee than if you were borrowing the money and then lending it and it was on your balance sheet. But if you just sort of say to, well, JP Morgan, HSBC, Lloyds, NAB, whoever they are, Barclays and BNP Paribas, listen, guys, give us a billion. We'll lend this out to people. We'll vet this for you. We'll work out the risk. We'll do all the due diligence for you. You'll basically get a mortgage book from us of suitable people based upon the criteria you give us, that kind of thing. We'll charge you this fee, and it's all done for you. It's a managed service. That's what they've kind of worked towards, or that's what they have done in the last 18 months or so. So that's sort of the change of business model that they've been engaging in. So running down the balance sheet, they haven't entirely done that. They've still got 600-ish million being lent out directly that's on the balance sheet. We'll have a look at that in a minute. But yeah, that's kind of what they're doing. But the fact that this is growing pretty fast is actually pretty exciting. More on that in a minute. What you'll see here is that this unutilized, so the principal investments is the on balance sheet or the direct lending. Third party funds, as I say, that's where you're doing a managed service for JP Morgan, etc. So as you can see, the majority, 3/4 of the funds are those. 400 are directly LendInvests. When I say they're LendInvests, they've borrowed money from bondholders, and that's the model. Now, obviously, for that money to be sat there doing nothing would obviously be not a good thing, should we say? So the other thing that they do is that that they will have other interest or interest income, where they're just putting it into like money market or different things. So yes, they're lending money that they've got to pay bondholders 6.6 or 10.7, but they're also earning some money whilst it sits around, um, waiting to be used, waiting to be lent. So that's the model essentially. So and the way that works is that you'll see that you've got fee expenses. So fee income is this, so on the buy to let, 3.4 minus 0.5 expenses gives you the net 2.9. Interest charges of 20. Quite a lot of that is going to be sort of payments to bondholders, I would suspect. I haven't forensically gone through it, but I'd suspect that's what. And then this is sort of the money you're getting from mortgage holders paying their mortgage off, or paying interest on their mortgages, on their buy-to-let mortgages. So anyway, that's yeah, sorry, I don't want to sort of get too granular on all the detail, but this is basically the model of what you're buying into if you do buy into this. And as you can see, year on year, funds under management up 12%, platform assets under management, so platform being direct, they're actually platform assets under management, sorry, funds under management is how much have I got available to lend. Assets under management is how much have I lent. So new lending is, you can see it's up 30%. Now it's interesting because obviously 539 plus that would be about 3.2 billion, but it's not 3.2 billion, it's 2.945. So the other concept, and I'll sort of show you this because I've done quite a lot of calculations around this, is sort of trying to work out for each period, not just sort of how much new lending did they do, but how much old lending kind of came off. So you can sort of see it here that in that period that we're looking at there, that the expiring lending was sort of 1.1 billion. This is pounds billion. The new lending was this 1.3. So you've got sort of a net. So I've kind of put this net expansion AUM. Sorry, it's this one here. So you can see it's going up by sort of 0.1, 0.08. So 100 million, 80 million, 170 million, and I won't show you the exciting stuff for a second here, but it's going up, but it's sort of not sort of massively fast. Fast forward, because what we also get is a trading update in January where they say, guess what, we've basically sort of, you can see this lending run rate, okay. Basically, 2024, we had a record year, bigger than the record year back when we were making loads of profits. So back in the day, let's go back down into here. Yeah, back in the day, in 2021, they made 5 million profit. In 2022, they made 14 million profit, as they did in 2023. The wheels came off in 2024 because guess why? Interest rates went up, supply chain shock, change of government, good old the prime minister that got beaten by the lettuce, Liz Truss. Liz Truss came along. I mean, obviously that was in 2022, but the kind of fallout. And by the way, this number here would be March 2023. So Liz Truss was September 2022, if I'm not mistaken, whereas this would be up to March 2022. So the year 6 months before Liz Truss, it made loads of money. 6 months kind of between and after Liz Truss, it still made loads of money, but shortly thereafter, from April onwards of after the April after Liz Truss, so 6 months after Liz Truss, the wheels fell off this good and proper. And when I say good and proper, impairments, admin expense grew out of control. Obviously, there was some level of contraction, just quite a few things where they'd overextended themselves potentially. I'm not connected with this company. I'm not connected with any of the companies I talk about on these videos, but that's kind of my outsider looking in perspective of what happened. So anyway, the good times happened in the past, and you can see here, on the back of Liz Truss. Well, it was happening before Liz Truss, but this, by the time we get to the annual results here, look, that's the annual results here. So record profits, but obviously with interest rates going up throughout 2022, pretty much, what, a month or two after they announced record profits, yeah, the interest rates are what, 50 times higher than they were back here. So they were at 0.25 and they grew to 5.5, wasn't it? Oh, 5.25, sorry, 5.25. So anyway, and they've fallen back now to 4.25, so they're down a bit. Sonia, who's Sonia? Sonia basically is the price of mortgages, or the underlying cost of mortgages. Normally there's it's Sonia plus, when you're lending money, that this is your kind of start rate, and then you obviously want to make a profit on top of the start rate. But you can see, year on year, 12 months, Sonia is down 10%, from 3.93 to 3.66. So the 5-year swap rate, which is what mortgages are generally based upon, is down by quite a lot, and base rates are down by a little bit as well. So all looking good. This shows you mortgages. So compared to back then when they had their record profits and 6 months after Liz Truss, mortgages were down at 52 billion per quarter. They're now, latest results, they're 50% higher, 77.6. What I would call out is the buy-to-let market's not doing that great. It was 8.2. It's sort of, well, it did drop down to 7, but it's at 8.2. So it's not sort of flying. But it's interesting because when you look at LendInvest's share of this 8 billion per quarter market, and bearing in mind this is 8 billion of new lending, so this is sort of, obviously there's going to be old lending that comes off the boil. But when you sort of compare the numbers, the proportion's actually pretty favourable, because what you're sort of saying is that LendInvest have got a 2.5 billion share, assets under management, 2.5, which is 0.8% of that buy-to-let market. So the buy-to-let market's 300 billion in total. They've got 0.83. But the buy-to-let 8 billion a quarter is 32 billion per year. Yeah, 4 quarters in a year. So basically, if they're lending, well, let's say 500 million, so you're essentially addressing 1.5% of that market. So 98.5 is being lent by somebody other than LendInvest. So the idea is that there's plenty of expansion. You like the fact that this is 8, and it's sort of not really increased from 8.2 back 2 years ago. Personally, I wouldn't be too worried about that, because you could expand your operations 50-fold, and obviously you'd be a dominant player by that point, of course, in the buy-to-let market. But you could grow your share of market and still have plenty to go after, and that's before you even think about going after the 11 times larger total market. So yeah, and that's all for the positive as well. So yeah, so that kind of gets us to and a couple of other things to quickly call out. They've consistently been winning awards for being best digital lender, best for online systems. So if you go and look at their news coverage, which is here, that verifying that I'm human. Okay, not sure how clicking on a web browser does that, but anyway, let's just assume that it has ways and means. Okay, come on, stuck here. Actually, I'll have a little slip whilst we're waiting for that to. So you can see the news flow is that they're reducing their buy-to-let range by 10 basis points. They're celebrating best lender. They're dropping the 5-year residential rates, introducing the cashback incentive. reduces rates to new lows. Now, obviously, all of this is on the back of that reduction in SONIA. The SONIA's dropped by zero point 0.4, so dropping that by 0.1, kind of that's just part and parcel of the mortgage market opening back up again. But obviously, all these reductions are going to drive more demand, going to drive more, reduces rates. And this is just back to April now. So, zero point 0.2 off. Wins a further 250 back in. So that's assets under management. We'll come to that in a second. As well. So it's all sort of heading in the right direction. We have a look at this going forward. So they announced in their last update, which was January, well, look, guys, our run rate is now at 1.43 billion. So they said in the year of 2024, they had a record year. So the run rate for the 12 months of 2024, obviously 3Q25, because it's March 2025 year end. So you can sort of see here, compared to sort of, let's say, the post Liz Truss hangover, let's call it that, it's nearly doubled. And actually, they say in December the run rate was this 1.48 billion, which is getting close to doubling, and it's still increasing as far as we can tell. All looking positive. They also tell us that well, you saw the little announcement there that there was another 250 million. So that's that number there compared to that number there. But then there was also an increase of funds under management with another, I think it was another 500 million that extends this. So it's this number here extending to this. This extending to this. So as you can see, compared to say a couple of years ago, the funds under management have nearly doubled. The assets under management, we don't know what those are, but I mean, if we extrapolate out new lending, it's got to be, obviously with this lending run rate here, and if we say, well, okay, there's a 0.3, 0.4, let's say a 0.4-ish expiring lending. And this is just an estimate. I mean, you can see there was a blip with 0.8, so it's not sort of nailed on that it's going to be this level. But if it is, I mean, where we land is that there's a 0.37 reduction. There's I'm going to use the 0.148, so I'm just saying in the 6 months to March, the average is 0.148, which is, it was 0.143 in the first 3 months. It was that in the third. So it to kind of average at that level doesn't seem unreasonable. And you can see here, I sort of say it's 1.5, 1.6 for the next couple of years, which again is not doing any kind of particular acceleration other than saying they're going to carry on doing what they're already doing. And let's look at what that kind of looks like. So if we sort of do that, the new lending, I'm keeping the direct lending, direct assets under management at the static 0.56 million, 560 million. Obviously, at some point, this would probably or potentially drop away because of those bonds expiring. Who knows? But they might extend them, they might replace them. Who knows? But I mean, I'm just making no assumption around what happens with those other than steady state. But what we see, and this is the crucial point here, is that, just in the same way as assets under management being pretty much the key thing that drives the fee income, has gone from 1.6 to 2.95. And then in March, the estimate based upon that run rate, based upon that expiry rate, is 3.3. Okay. And then it sort of, again, same growth rate more or less, gets you to nearly 5 billion assets under management and something like 6.5 funds under management by 21 months time, which isn't that far away. But yeah, if you agree that that's a reasonable extrapolation of what's already happening, and that also assumes there's no further acceleration, they're launching a residential mortgage product in this coming half year well, from, sometime after July. So who knows? I mean, I don't think this is particularly unrealistic to assume that it could do something along these lines. If that's true, then well, you can see now. Apologies, I've done it. Dates going that way, and then it's going the other way. Um, I should have probably thought about this, but yeah. So what I do is I sort of say, well, the net interest income, which is driven off this direct lending, I'm just saying that stays the same. I'm not assuming that increases. And as you can see, there were these blips where, as I say, the wheels fell off, as I call it, which was impairments and things like that. But you can also see that the advantage of net interest income was when you had good times, you had really good times. So it's kind of, we're replacing good times and bad times with a sort of steady eddy approach. But this net fee income is just getting driven as a function of the assets under management. Now, I don't have any kind of exact formula as to what these look like. This was kind of where I was playing around with the numbers a bit, sort of saying, well, what are the ratios of these different things? So it is just a best guesstimate on the growth of this net fee income, and this divides into buy to let and the short term lending. So you can see it grows, but not vastly, not I'm sort of, like you see here, it's growing by about 1 million a year, or sorry, 2 million a year, because these are 6 monthly segments, of course. So it's not sort of, and these are just sort of functions of this AUM and this new lending. So I'm making assumptions that as you make new loans, there's obviously fees, like arrangement fees, that kind of thing. But then you're also charging fees to just manage people's money. You charge a percentage of the fees under management, but they take the risk. You see, so the good thing is that if I don't know, pick JP Morgan as the first one on that list of badges. If JP Morgan has a mortgage that goes smelly, well, it's JP Morgan's mortgage that goes smelly, not LendInvest's. They might lose the asset under management fee, but they don't lose the value of they don't have to sort of repossess the house, they don't have to the property, don't have to kind of sell it, make a loss on disposal, any of that. That's someone else's problem, which is quite a nice thing to have. And I mean, the lower profit, okay, but the real value here, as far as I can see, is to do the best job you possibly can to have an investment, or sorry, to have a platform that is useful for people to you know apply for mortgages that are complex. And the sorts of people that apply for these mortgages are sort of, oh, I'm a taxi driver and I get cash in hand, so I don't have proof of income because nobody pay, I get like 10 quid for driving people from A to B. I've got 3 jobs and I sort of do this, and I get, I've got a job that I do YouTube podcasts about weird companies and I get paid this from this. I mean, that's not the case in my case. I just do this out of the goodness of my heart and for the fun of it. I'm sort of giving you the examples of these kinds of scenarios where it's quite difficult to get a mortgage if you're self-employed, or if you've got sort of overseas income, or like all of these sort of permutations, or maybe you've got multiple jobs. Sort of these kinds of mortgages are sort of quite cumbersome and clunky. So the beauty of the LendInvest platform is they've sort of thought through all of these kinds of scenarios, and this is why they're winning sort of best provider, best specialist provider, best for specialist finance, that kind of thing. So that's yeah. So the implication of and by the way, they did cut costs. They moved to Glasgow. They cut headcount, so admin costs drop, and I've sort of said they'll sort of steadily go up. But again, you could sort of make your own judgment call on that. But what you'll notice is the profit before tax under this model really grows very fast. And as you can see, I'm not really doing anything other than just saying, well, the net fee income grows because the assets under management grow, because they're already growing. So they're just going to carry on growing at the same speed. That's all I'm saying. But where that lands you, quite incredibly, in 21 months' time, is at a price earnings. I mean, if my model is correct, I'm not saying it is, but a price earnings of 2.9 times. Whereas, I mean, obviously on the last official results, the price earnings, well, they lost 20 million. Like I say, when the good times were there, they were good. When the bad times were there, they were bad. So you can sort of see here there was impairments. There was vast admin costs. Well, I say vast, it wasn't vast. It was like 8 million more than perhaps it otherwise should have been. You can sort of see it there comparatively, but that was enough just to kind of, and also you can see here there were some areas where, bearing in mind that this is other net income, that net, that there was quite a few instances where the net fees were actually negative, so their expenses outweighed their fees. So again, that was sort of another aspect. So this chart here, the lending run rate, this is the thing that I suppose the one artifact that above all others that sort of makes me quite interested about this. Obviously the technology itself, it is quite interesting that they've obviously put a lot of money, 45 million was the last count, into building this platform. I'd also call out, this was a holding, Cushion was a holding with Augmentum FinTech, and that sold for 170 million, so about the same as what BETR, the huge loss-making firm, sold for. And if it were to sell for something like 170 million, I'm not saying it can and it will, but if it were to, I mean, that is triple today's market cap, and that would be 170 million for the platform, not including the fact you've got, you know, several billion assets under management, profitable business. So Cushion, by comparison, didn't have that. They were, well, I don't know what their metrics were, but they weren't of the same level as LendInvest in terms of their their um, their run rate profitability. So yeah, there's a video here if you want to sort of dive into the technology. Obviously, the video is a few years old, but it sort of gives you a good idea. They're obviously trying to drive their coverage of mortgage brokers, is sort of an ongoing journey for them. Oh, sorry, it wasn't 45, it was 60 million that they've spent, and that number is a year or so old, so that could, well, in fact, almost certainly is going to be a higher. The other thing to say is that the asset on the balance sheet is only held at 10 million pounds. So if we look here, the intellectual property, I think, is this line here, if I'm not mistaken. And yeah, it is. Yeah, the net um, the net value of let's see if we can find it, amortization. Yeah, so they're depreciating the system, the portal, by 2.2 million uh, per 6 months, so 4.5 million a year. Amortization of intangibles is sort of, that's obviously part of the cash flow. Yeah, so internally developed software, amortized over 5 years, internal costs. So what will happen is, of course, that you'll have uh, more development of the system. So that's where they will capitalize those costs. What that means is they incur them, like say you've got a team of developers in the next room, and let's say I'm paying each of them 100,000 a year. So let's say there's four of them in there. So they're costing 400 grand to somebody. That 400 grand, what I do is I put that on the balance sheet to say all the stuff that Nextdoor have done in the last 12 months is now worth 400,000 pounds as an intangible asset. Okay, so you can sort of see, they're sort of depreciating it or amortizing it here, which is taking it off the balance sheet, as well as adding it to the balance sheet. So the idea, though, is that the amortization means that, what, something like about 50 of the 60 million they've poured into this platform has actually been written off and costed against the business. In other words, you're only paying 10 million of the assets of the company that you're buying. You're only paying 10 million for a 50 million or 60 million, sorry, asset. So again, that's something that is because of course, you know, you make your own judgment call, but I don't think fundamentally um, that platform is worth any less than it was 2 years ago, 5 years ago. Obviously, it'll have new features and functions in there, but it still does the same job fundamentally as it did back then. Probably just does it quicker, better, faster, and so on. But you know, that's sort of an area of value to consider as well. And of course, if we say, I seem to have you know, you can buy the whole thing for 55. Well, the assets, you know, the equity is 56. So you're not even, I mean, obviously there's not a lot of difference in it, but you know, you're actually buying this for slightly below the book value of the assets. As I say, like the book value of the assets sort of assumes that all of the development that's gone into that lending platform is only 10 million. You know, it's whilst it actually costs 60 million worth of development. So that's you know, like normal a normal business like this wouldn't be at book value. Is what I'm trying to perhaps say. And obviously, quite a lot of this book value, if I just say as well, that they've got 70 million of cash. Now, quite a lot of this is restricted cash. In other words, in order to borrow all of this money here, 601 million, what they've had to do is put a load of money into a ring-fenced bank account, and this is what they call restricted funds. So they can't go and spend it. They can't, you know, they don't actually. They've got 70 million of cash, but they can only touch probably about 10 of that. 60 million is about ring-fenced. So what that means is when you buy this, you know, the if you actually were able to take out the cash, you know, you'd actually have sort of after paying that amount of money there, you'd actually have about 17 million pounds cash in your pocket, and you'd have a business that, to be fair, you'd owe somebody 70 million quid worth of liabilities, but you know the amount of cash in this business actually exceeds the market cap by quite a way as well. So it's another interesting aspect to consider. But this one with the carried forward balance, and because they're writing it off at such a speed that the platform would be like essentially worth zero as according to the balance sheet by the year 2029. You know, but obviously they're going to develop it further, so it's unlikely to get to zero. But that's sort of again a kind of an interesting aspect to this. So I don't think anybody has really, well, actually, you know, a few people have understood and appreciated this because that's why this has been going up in price. But I mean, if we take the long-term picture, like I wouldn't be too worried about the fact it's gone up by a bit because you can sort of see here, you know, it was. I mean, obviously, if you bought it at you know, £2, sorry, yeah, £2 a share, then you'd probably feel a bit unhappy, let's say, with the fact that it's now only worth 40p. Uh, so, you know, apologies to anybody who is in that category that you're probably looking at this video going, oh, I hate LendInvest. I lost 80% of my money. Well, yeah, you would have done. But, you know, for those of you that were smart enough to get in, you know, at the turning of the tide, and I suppose, you know, there's some people, I mean, I don't really get into what do they call it? You know, the chartisms and you know, the chart says there's a bull. Well, I mean, to me, people that talk about charts are really just sort of like, you know, the fundamental analysis, the fact that they are lending more money than they ever have before. That's the reason the share price is going up. Their business performance is improving, and here's the proof of their business performance improving. Like saying about the chart and the bull, like that's a symptom of the business performance. So I look at it quite differently, to be fair, but that's just me. That's my approach. Everyone's different. So that kind of concludes this article. Will be out in the next day or two. None of this is advice. So it's just purely to just clarify my thinking prior to releasing the article. Hope that's been useful, and more Oak Bloke videos coming soon. Obviously, if you want to follow and subscribe, you can. I'd really appreciate you if you would like the video and share it and all of that marvelous stuff. If you like what you've seen, if this has been useful, and there's also a link to the Emmaus, help Emmaus, which is here on my website. So there's 600 and how many articles are there now? 600 and 600 and 600 and something, 620. There we go. So there's lots and lots of articles to read through. Obviously not all about the same thing, or not all about different things, but yeah, lots and lots of ideas, and good, bad, and ugly. Some shares that I like that one was one where I'll probably do a video on Skihallion, if I'm pronouncing that correctly. Probably do a video on this one. Well, actually, yeah, I'll probably do a video on quite a few of these at some point. But yeah, anyway, that's enough from me. Hope that's been useful, and Oat Bloat signing off. Cheerio for now. Cheerio.